Please see the full disclaimer on your screen before we begin.
Let's just jump right into it. Welcome to this explainer. Today, we're dismantling a classic industry myth. For decades, the ultimate commercial real estate icon was this rugged individualist, right? The lone wolf who scouted the asset, secured the funding, and managed the whole shebang entirely on their own. But listen, commercial real estate, it's not a Clint Eastwood movie. Looking at the data we have for 2024 through 2026, that narrative has totally flipped. We're going to explore why relying strictly on your own expertise isn't just outdated, it's literally a massive liability. And more importantly, we'll see why building a shared network is the new gold standard for protecting your capital.
Take a look at this contrast. We've got the lone wolf on one side. It used to be a real badge of honor to do it all yourself, keep all the equity, make all the calls, take all the glory. But look at the harsh reality on the right, the sitting duck. Because of the sheer overwhelming complexity of today's market, trying to process every single variable alone leaves you completely blinded by your own individual risk tolerance. You inevitably have blind spots. You aren't agile when you're flying solo anymore. You're just an easy target for a volatile market.
Here's our playbook for today. First, the death of the lone wolf. Then, modern complexities and market risk. Third, why shared analysis actually wins out. 4, moving from solo to shared. And finally, building a resilient fortress around your principal. Let's get to it. All right, starting with part 1, the death of the lone wolf, or, as I like to call it, the end of the solo cowboy. Looking at the 2026 Canada real estate market outlook from CBRE, it's absolutely clear that persistent uncertainty, crazy interest rate volatility, and shifting trade policies make the lone wolf uniquely vulnerable. I mean, we are not operating in a straight-line growth economy anymore where a rising tide just lifts all boats. Every single asset decision today is weighed down by macroeconomic forces that can literally change overnight. Think about it. How can one single person accurately model shifting global trade policies while simultaneously tracking hyperlocal interest rate impacts on, say, a random Tuesday afternoon? Well, spoiler alert, they can't. The cognitive load is just way too high. And that's exactly why the solo approach is fracturing right now under the weight of these persistent threats.
Which brings us to Section 2, Modern Complexities and Market Risk. Let's see how to navigate this new landscape.
So here's the deal. We aren't just looking at local vacancy rates anymore. We're navigating really complex demographic shifts in what researchers like Orhan define as shrinking cities. Now pay close attention to that phrase right there, market heterogeneity. Basically, this means a city isn't just uniformly good or bad to invest in. It's like a giant puzzle. One neighborhood might be totally booming because of a new tech hub, while literally 3 blocks down the road, shifting demographics make a property completely unprofitable. Navigating this crazy level of neighborhood-by-neighborhood nuance demands incredibly specialized hyperlocal knowledge. A solo investor flying in from out of state just to look at a spreadsheet, there's no way they can capture the nuance required to survive in these shifting micromarkets.
Moving right along to Section 3, Why Shared Analysis Wins, or what we call the power of the posse.
I absolutely love this quote from Casamatta and Hardchabalet because it is just so foundational. It proves that pooling our expertise completely mitigates the dreaded blind spot risk. No matter how brilliant you are, a single set of eyes always has blind spots. You might be an absolute genius at structuring debt, right? But maybe you overlook a tiny flaw in the physical foundation of the asset, or maybe a pending zoning change that snuck under the radar. By co-investing and syndicating, you aren't just pooling your money, you're pooling scrutiny. You're subjecting every single assumption to a 360-degree stress test by multiple experts. And honestly, this dramatically improves project selection because a bad deal is way more likely to get caught by a group of specialists than by one solo generalist.
By comparing these two approaches here, we can see data from CPO's 2026 research showing that diversified, real estate-focused portfolios actually offer superior downside control compared to broad equities. When you co-invest, you don't have to sink all your capital into a single massive asset. Instead, you take that same chunk of capital and grab smaller positions across, say, 5 different assets in totally different markets. If one takes a hit, the others stabilize the rest of your portfolio. Broad equity indices just don't give you this targeted asset-level downside protection. Basically, co-investing allows you to achieve the kind of diversification and post-COVID resilience that used to only be available to the massive institutional funds.
Notice the word competence on this slide. Co-investing isn't just a basic crowdfunding exercise. According to Brander's research, the real reason these shared investments yield higher returns isn't just the extra cash, it's the extra brain power. Imagine this. Partner A brings brilliant tax optimization strategies. Partner B, they bring deep, long-standing relationships with local contractors. and partner C knows exactly how to navigate the headache of the municipal permitting office. This unique combination of information and skills adds tangible, measurable value to the deal that a lone wolf simply cannot replicate.
Okay, Section 4. Moving from solo to shared. This is your practical how-to playbook.
Transitioning to this new model requires a major shift in both your mindset and your mechanics. You can't just, throw a group chat together and call it a syndicate. You actually need to follow these 3 actionable steps to build a well-oiled machine. Step 1, standardize the underwriting. Step 2, get boots on the ground. And Step 3, define the governance structure. Let's walk through each one of these.
All right, Step 1, establish a shared language. You've got to focus on rigid downside risk metrics, not just get starry-eyed over potential average returns. When you form a posse, the absolute first thing you must agree on is the math. Everyone needs to underwrite using the exact same models. And more importantly, you have to prioritize downside protection. This means running rigorous stress test scenarios, like what actually happens to the deal if exit capitalization rates expand significantly by the time you go to sell. If the deal only works in a perfect, sunny, best-case scenario, a smart shared network is going to pass on it. You have to standardize exactly how you measure that worst-case scenario.
Now this brings us to the consensus trigger, which is fantastic, because it completely removes human emotion from the equation. Before you even look at a property, the group establishes a hard threshold. For example, if your stress test pushes the debt service coverage ratio, or DSCR, below 1.2, the deal is dead. Period. No arguments, no ego, no gut feelings trying to save it at the last minute. The consensus trigger is basically a predetermined failsafe that protects the group from falling in love with a bad asset.
Moving to Step 2. This builds right on our understanding of those shrinking cities we talked about earlier. Shared analysis isn't just about perfectly formatted spreadsheets. You absolutely need boots on the ground to ensure that digital data matches the physical reality. A pro forma might look spectacular on your monitor, right? But if the local partner drives by the site and sees that the huge anchor tenant across the street just boarded up their windows, well, that deal is dead. Co-investing works best when at least one partner truly lives and breathes the hyper-local market sentiment. They provide that critical physical reality check that a distant solo investor entirely lacks.
Finally, Step 3. Clear governance and direct co-investing keep more capital in the asset by bypassing high fund fees and carried interest. Listen, co-investing completely falls apart when decision-making gets muddy. You must have a legally binding operating agreement that clearly defines major decision rights, like who actually has the final say on refinancing? What are the exact provisions if the property needs a sudden capital call to fix a collapsed roof? By directly co-investing and defining these rules yourselves, you're retaining control and avoiding the massive management fees of traditional blind pool funds. You're letting your capital actually work for you.
Let's head into our final section. Section 5. Building a resilient fortress to protect your principal.
Protecting your downside means swallowing your pride. As Priyanshu Adathakar points out right here, in commercial real estate, ego is an expensive luxury. It means admitting that a collective of focused experts operating with a shared language and local knowledge is infinitely more resilient than a lone genius trying to perfectly time the market. Ego tells you that you don't need anyone else looking over your numbers. Ego tells you that you can outsmart macroeconomic headwinds all by yourself. But in today's commercial real estate environment, ego will literally cost you your entire principal. I'll leave you with this final provocative thought to consider as you evaluate your own risk and resilience strategies in this uncertain market. The lone wolf, the rugged individualist, the cowboy, that whole way of doing business is dead. It's been completely replaced by the power of the syndicate, the shared analysis, and a diverse network of competence. The market is undoubtedly going to get rough over the coming years. The question isn't whether you're going to face headwinds. The question is, when those headwinds hit, are you standing alone like a sitting duck, or are you protected by the collective strength of your posse? Take a hard look at your current strategy, find your experts, standardize your underwriting, and build your fortress. Thanks so much for joining me for this explainer, and I'll catch you next time.